Good afternoon, everybody. I realise it's midsummer and everybody's really busy, so I'm grateful that so many people have found time to join Diane and myself talking about H&T and about our progress year to date. And I will be talking about some of the strategic things that sit behind it. So in terms of a bit of an overview, this is actually a store we opened this year in Leeds Merrion Centre. I think we've made really strong progress in the first half of this year. We've had good growth in our lending demand. I think our retail business has performed particularly strongly, and we'll talk more about that later. And we've now got traction in our FX business, which I'm also very pleased about. The one thing that we didn't anticipate was a significant increase in the propensity of people to pay their loans back earlier than they would otherwise have done historically. And that went on. It happened for the first time last year, and it happened again this year, except this time it went on for longer than it did before. And I think in our planning assumptions, we are now of the view that this might be a new normal, and therefore that it continues to happen is reflected in our planning assumptions and in the forecasts. So I think we've made really good progress. What I'm going to do, though, for those of you who don't know H&T particularly well, is just explain a little bit about who we are, what we do and where we do it. H&T, it's Harvey and Thompson, founded nearly 130 years ago now, the UK's largest pawnbroker by some margin. We say a leading retailer. The last time a league table was published, we were actually a top 6 retailer of new and pre-owned jewellery and pre-owned watches. We don't sell new watches at the present time. Overwhelmingly a stores-based business, currently 282 stores. Market drivers, we have products that primarily bring footfall to the stores, but overwhelmingly we are a pawnbroker and jewellery retailer. And those two things are very closely linked, which Diane and I will talk about a bit later. There is still an increasing demand for small sum, short-term regulated credit. And right now the supply of that is and remains constrained. A lot of demand is going on to buy now, pay later, but actually the regulation of that will come at some point. And when it does, I think the supply may be even more constrained than it is currently. And as we're seeing, I think with the growth in our retail business in the first part of this year, people are looking for value for money. And the jewellery that we sell does represent very good value for money. We want to deliver a service that exceeds expectations. Now, everybody says that, but we really mean it here. And we encourage anybody who's never visited one of our stores to perhaps do so. You might find it slightly different from what you expected. So in terms of strategic focus, number one is to grow the pawnbroking pledge book. We'll talk a lot about that later. Investing in our store estate, new and existing, and we are continuing to invest in our IT platforms to support the business better. Ultimately, inflation aside, this is a primarily fixed cost business. And therefore, our job is to drive revenue in order to increase operational leverage and improve returns to shareholders. So that's who we are. This is what we do. A range of products dominated by over 80% of revenues being generated by pawnbroking, retail, and the downstream scrap revenues that we get from pawnbroking. The reason the proportion from pawnbroking is lower in 2024 than 2023 is because pawnbroking revenue grew less. And the reason it grew less was for the reasons that we will talk about later to do with redemptions. So a range of products, but actually our revenues are dominated by pawnbroking and retail. So this is where we do it. We have a store estate currently of 282 stores, national business, but not yet national coverage. So there are still parts of the country where we are underrepresented or unrepresented. And there are towns and cities where we perhaps have a store, but because of where it is, we're only serving part of the addressable market. So a nationally based, stores-based business. We've spent a lot of time and effort in improving our online presence, look, feel, and to an extent the customer journey. We're doing more around the latter. It supports retail very well, although interestingly, nearly half of our retail sales by value that are booked online, the customer sees it in a store before they buy it. So the stores are actually fundamental to the online proposition. And it also works well for foreign currency. We do click and collect, which is also growing, and it's pleased to see that. So overwhelmingly a stores-based business, but investing in supporting that business better with technology. So that's a little bit about who we are, what we do, and where we do it. I'm now going to hand you across to Di, and Di is going to take you through the half-year numbers, and I will come back later and talk about some of the strategic stuff.
Thank you, Chris, and good morning, everybody, or it's afternoon already. Thank you for joining us. I'm going to cover the financial results, going through the financial overview, and then I'm going to move into our segmental results and go through each product line later on in the presentation. So starting with some financial headline summaries, I'd like to pull out some key highlights. Starting in the top left corner, our income from operations grew by 11.4% to June to £55.8 million, as our pawnbroking and retail revenue continued to be our core contributors, along with improving gross profit margins in both our retail and our scrap products. We earned a profit before tax of £9.9 million, which is 12.5% up on 2023, while our balance sheet grew by over 8% to £181 million, with our largest asset being our pledge book that has a capital value of £105 million, which is up 4% from June 2023. We have generated a return on equity of 12% as we continue to work to achieve our through-the-cycle target ROE of the mid-teens. If we now turn our attentions to the graph on the right, what we can see in this graph is the distribution of our revenue and our costs throughout our financial year. And it's important to highlight the seasonality that we have in our earnings, which you can see are heavily weighted to H2. And this is because both of our peak FX, which is in summer, and our peak retail trading periods, which is at Christmas time, fall within the second half of our financial year. In addition to this, in spring of this year, what we saw was a greater number of our customers redeeming their pawnbroking loans, a pattern which emerged for the first time last year. Now, for those of you that may not know us that well, what we mean by redemptions is when a customer chooses to repay their loan and they collect the item from us. So all other things being equal, the impact of higher redemptions is a smaller pledge book. So what we saw in 2024 was these redemption levels. However, 2024's redemption levels were larger and they continued for longer than we anticipated compared to the prior year. And this makes the seasonality of our earnings now even more pronounced. So for these reasons, and on consultation, the board has decided to change our financial year end from the 31st of December to 30th of September, with effect from next year, 2025, allowing us to have a more even distribution of revenue throughout our year. If we look at our income statement, I've referred to the income from operations up 11%, and we'll go into more detail on that as we go through the segmental results a bit later. Our operating expenses have increased by 6.7%. Now, our employee costs make up almost 60% of our cost base, and these costs alone have seen growth of 7.7%, and this is due to government-led increases in our national living wage. Cost control is a key focus and a priority for us, and it will continue to remain so. Our effective tax rate increased to 22% as corporation tax increased last year, and our earnings per share increased to 17.7p per share, while dividends increased to 7p per share as we look to strike the balance between generating shareholder returns and our continued investment in our pledge book, our store estate, and our IT infrastructure. Our balance sheet. Last year, we began to report both the capital value and the carrying value of our pledge book, and we've continued to do so this year. The carrying value of our pledge book is £131 million, and the capital value being 105. The difference being the two, firstly, is accrued interest on the pledge book of £32 million, reduced by the required IFRS 9 provision of £6 million. We hold a total inventory balance of £49 million, and of that, £35 million is held for retail in our stores. As you will recall, we purchased Maxcroft in February, and we paid goodwill in the region of £5 million, which is the reason for the increase in our goodwill balance, while fixed assets grew with the investment of our capital expenditure in our stores, both new and existing, and also into our IT technology platform. Our balance sheet remains strong with a net asset value per share of 416p. If we look at where our cash flow was utilized in the first half of this year, it was utilized firstly to fund our working capital, secondly, continued capital investment in our store estate and our IT infrastructure and software development, And thirdly, the acquisition of Maxcroft earlier in the year, which had a purchase price of £11.4 million. If we look at our debt facilities increased in February of this year, and our total is now £85 million. Of that, £64.5 million was drawn at the end of June. We ended the year with a net debt position of £49 million, and we believe that these gearing levels still remain moderate for the group. We've included more details on all of our funding facilities in the annexure of the presentation. I'm going to now turn my attention to segmental results, starting with our core pawnbroking product. Our pawnbroking product is the core product of the group, and it contributes about 60% to our gross profit. Our pledge book grew this year to £105 million with strong borrowing demand, which was up 14%. And this came from both individuals and business owners who are looking to fund their working capital. The underlying metrics on your pledge book, being the loan-to-value ratios and the long-term redemption rates, have remained broadly consistent. However, what we saw in the spring of this year was an increase in redemptions, and it is similar to the trend we saw for the first time last year. And to recap, when we say redemptions, what we mean is our customers are choosing to repay their loan and collect the items from us. So everything else being equal, the impact of these higher redemptions is a smaller pledge book. However, 2024 saw that these redemption levels were higher than last year, and they continued for a longer period than we expected. So the combination of this has resulted in a lower duration of the loan book, which is the time period on which the loan stays on our book, and that has dropped to 94 days, whereas previously it was 97 days, and a smaller pledge book. So our redemptions have now normalized, and our pledge book has begun to grow, and our pledge book at the moment is £108 million. So if we take the combined impact of these redemptions that were higher and were carried on for longer than we expected into account, they have influenced our revenue in the following ways. So firstly, the pledge book is smaller, so we've earned less interest on the pledge book. Secondly, the duration, which is the time it takes a customer to repay their loan, is shorter by on average 3 days. So therefore, we reduced the average interest we've earned on those pledge books that have been repaid by 3 days. Now, with this redemption, which started to moderate in late June, which was later than we expected, the vintage of our book, or the age of the pledge book that we have, is slightly younger than normal. So with this younger loan book, the interest that we are accruing is lower, as those new loans have only been on our book for a few weeks. And finally, IFRS 9. IFRS 9 requires us to accrue interest on our loans at the lower of the effective interest rate and not the contractual interest rate. Now, the differential between these two interest rates is the largest at the start of the loan, and it decreases as the loan matures. So the young vintage of our book required an additional effective interest rate adjustment. So the combined impact of all these factors is lost pawnbroking revenue of somewhere between £2 and £3 million. And this is what has contributed to the lower annualized yield that we have earned on our pledge book of 57%. Our planning assumptions and our market forecasts, which we now have 3 published in the market, assumes that the seasonal dynamics is now the new norm, and we will seek to offset this if possible as we move into the future. If we now look at retail, we are very pleased with the results we have achieved in our retail team. We have seen 27% growth in retail sales revenue up to June, and of that, almost 1/4 was generated online. We have also seen growth in unit sales, and those are up by 17%. So what we saw at the start of this year is a reversion to a more normal spending pattern and sales mix for our customers, and they have actually shifted their demands more towards new jewellery and pre-owned watches. Now, both of these have lower margins than our pre-owned jewellery ranges. However, the increased demand for pre-owned watches is seeing us now retailing watches that last year we would have scrapped. So this change in the sales mix, along with the traditional January sales activities that we have in Q1 of our year, has achieved a margin for the first 6 months of this year of 30%. Our current margins are slightly higher than this. We also continue to invest in our online proposition, and that is to support our retail growth. Foreign currency continues to receive focus and attention. Our transaction volumes have increased by 9% and profits have grown by 10%. And our peak FX period for trading is still to come in the second half of the year, which is July through to September, and for us actually reaches into October. You'll recall we bought Maxcroft earlier in the year. Now, the Maxcroft foreign currency business is significantly larger than our business or any of our busiest H&T FX stores. So what we have done is taken the learnings that we have gained from Maxcroft, and we have applied those to our selected H&T stores. And we're very pleased with the results where we've seen increased footfall and revenue sales. Likewise, the Maxcroft FX business has also benefited from being part of the H&T Group, as they are benefiting from an increased amount of FX cash that they now have available in their stores and have increased their revenue. Pawnbroking and purchase scrap. Now, both of these products are supported by the strong gold price, and you can see this play out in the improved margins that we're seeing in both these product lines. Gold purchasing volumes for us have stayed broadly flat year on year, while pawnbroking scrap, we are seeing an increase in the volumes. And the reason for that is because this is the realization of the value of the collateral item that we held for a pledge loan that has forfeited. So naturally, this will grow commensurately as we see growth in the underlying pledge book. And the final slide from myself today covers our other services. Our other services are offered so that we can primarily bring footfall to our stores. They cover two products, generally the money transfer product as well as our third-party checks. Money transfer is our partnership with Western Union, and we are their biggest partner by volume. And what that does is brings more than 500,000 of our customers to our stores every year. So this brings me to the end of my portion of the presentation, and I'd like to hand back to Chris.
Thanks, Di. So what I'm going to do now is look at some of the strategy that sits behind some of the things that we're doing and trying to answer some of the questions that we're often asked. And then I'll talk a little bit about the outlook. So if we start with Maxcroft, why Maxcroft? It aligns perfectly with our strategy, our core strategy, which is to grow our pawnbroking business and broaden its attractiveness. So Maxcroft's customer base is skewed towards small business owners using the product primarily for working capital. This is something that we've always had, but it's something we wanted to focus a bit more upon. And to put that in perspective, currently, including Maxcroft, about 18% of our loan pledge book is represented by loans of £5,000 or more. The majority of those have been used for business purposes. Now, it's less than 1% of customer numbers, but it's about 18% of the book, including Maxcroft. And it's something I think where there's a real opportunity. They tend to be shopkeepers, builders using it to pay wages and to buy materials. We've got customers that use it to pay the quarterly VAT bill. But I do think it's something that we can focus on, and we are learning from Maxcroft how they position their business to attract that sort of customer. As Di said earlier, their foreign currency business was more successful than any of our stores, and we've got some learnings for that, which we're beginning to apply within our stores. And where we've done so, we're starting to see footfall and transaction improve as a result. The integration's gone well. We've extended the consultancy agreement with the previous owner, who's been really helpful to us. Like H&T, the pledge book is broadly flat since we purchased it, and I'm really glad we bought it. I think there's a lot we can learn from such a successful business. And the only other thing I would say is, look at the right-hand side of that slide. They are overwhelmingly a pawnbroker and a gold buying business. They don't really do retail, and that's something that we may choose to look at going forward. So we're often asked about new stores, rollouts, how the stores evolve, where is the growth coming from? So I'm going to try on this slide to answer some of that. We've opened 5 shops currently this year. We will probably open between 8 and 12. We will be measured and cautious in opening stores because we don't want to open them and wish we hadn't. The overriding priority, the most important thing, is location. So we have a list of places where we want to be. If there happens to be an existing independent pawnbroker who's based there who wants to sell their business, that's great. We'd be happy to buy it, but we would rather not do that and find ourselves in the wrong location. Much rather open one ourselves. Each store has a standalone business case. There's a lot of data that's used in establishing where you want to be, and it's predicated on the store being profitable on a run rate basis no later than year 2 and to make a profit in the full year 3. All of the stores that we have opened in the last 3 years or so meet that criteria. Now, the chart in the middle is an attempt to show where the growth is coming from. So we are defining, for the purposes of this, core stores as being stores that we've had since 2013, for 10 years. And the bars represent the size of the pledge book. And what you can see is over the period 13 to 18, there was effectively no growth in pawnbroking, apart from a small number of stores that were acquired. The business did not open stores in those years. They just bought a few. And you can see that what growth there was came from acquiring stores. 2019 saw some organic growth for the first time in some years. And in mid-2019, the group acquired 70 stores from the demise of 2 national competitors. And then came COVID. If you look at what's happened from 2020 onwards, and the bar on the right is 2024, but clearly it's only 6 months. I'd like to think the bar would be a bit bigger by the end of the year. But what you can see since 2020 is that overwhelmingly the growth has come from the existing store estate. Some of our largest pledge book managing stores are actually the ones that are growing the most, and very few, if any, of our stores would meet what you would call true maturity, i.e. they've fully maxed out on their ability to grow within the community in which they operate. So you can see the bulk of the growth has come from the core estate. But as each year goes by, the contribution from stores which have been opened or acquired grows to the extent that they are now growing, and have been for a couple of years now, more quickly on a relative basis than the store estate as a whole. Put another way, today's new store is tomorrow's pledge book growth. And without the store acquisitions and openings, we wouldn't have a pledge book that's as big as the one that we've got now. So I hope what I'm trying to explain here is that the growth is coming from across the estate, both core stores and new stores, but it does take a long time for a pawnbroking pledge book to grow to what we would define as maturity internally. A few stats on the right. The interesting one, I think, is the average income per store, nearly £900,000. Our stores and the people in them do work very hard for us and for our shareholders. So the store refresh program, we're often asked why. So we've put a couple of before and afters here of Boreham Wood that we looked at earlier this year. We do very, very few full refits, a handful a year or less. By and large, what we're doing is refreshing and modernising what's in there. It's all done in-house, so it's not hugely expensive. But if you look at the bottom left picture, that was how Boreham Wood looked before. I would say a bit 1980s with the panelled wood on the walls, the old clock, and old-fashioned building society type counters. What it now looks like on the right is lighter colours, more glass, a bit more welcoming, a bit more modern, and a bit more somewhere that you might be prepared to go in and get your foreign currency or to do a retail transaction. So our aim in doing this is to modernise the look and feel of the store estate to make it more attractive and more welcoming for people to come in. Not a huge cost per store, but in our opinion, fully worthwhile. So I was asked recently, why retail? Why do we do it at all? Well, I'm going to try and explain a little bit about that now. So about 80% of what we sell is pre-owned. The majority, significant majority of jewellery and virtually all the watches that we have for sale are sourced through our pawnbroking activities. In other words, these are items that have been used as collateral for a pledge loan where the customer has forfeited on the pledge loan. We buy very few watches over the counter. And as a result of that, virtually all of the stock that we have for sale, which is pre-owned, is sourced through pawnbroking. And in effect, what we are doing is realizing the value of or disposing of the collateral that we have held as security for a loan. Now, retail is really important to us. Our customers, when they have money, buy something and view it as a store of value. But the stock that we have for sale is there because of the pawnbroking business. And that, I think, makes us a little bit different from most others. We don't buy very much, if any, pre-owned stock in the market. New jewellery is really important to us. New jewellery tends to be lower price points. We will sell you a pair of earrings for £10 that's new. It is not economically viable for us to do that with pre-owned jewellery, because if it's pre-owned, it's got to be cleaned, polished, prepared for sale, and it's just not worthwhile doing it. But having that new jewellery in the stores means that we can sell you anything from a £10 pair of earrings to a £12,000 watch. There are very few places that you can go to do that. Now, interestingly, this year, we said we would work really hard on the ranges that we had for sale and the mix of stock that we had for sale. I'm really pleased with the progress in retail in the first 6 months of this year. We've got 17% volume growth, 27% revenue growth, but the thing that's growing the most is actually new jewellery. And our sense, a little bit alongside why we're redemptions higher in pawnbroking, is some people are feeling, I think, that they've got a little bit more disposable income, but they are prioritising where they spend it, and they are looking for value for money. And our jewellery does represent very good value for money. Online, as Di said, it's about a quarter of what we sell. It's grown commensurately with the overall retail sales picture. Half by value of the items that are sold online are actually fulfilled through a store. Somebody wants to see it before they purchase it. And our stores, therefore, are absolutely embedded in the online journey for customers. So hopefully that explains why retail. So I'm not going to dwell on the macroeconomics. I think we've talked quite a lot about this. We think demand for pledge lending will continue. There is an ongoing need for small sum regulated short-term loans, and we're seeing more demand from business owners, and we're learning how to access that opportunity more effectively as we go forward. I'll talk a bit in a minute about the seasonality that appears to have appeared within pawnbroking. For retail, I think the performance in the first part of this year shows that the demand is there, provided you have your stock and your mix right, and provided you offer good value for money. In fairness, on foreign currency, it took us longer to get traction than we expected it to. We have now got traction, so we've grown transaction volumes 9%, revenues by 10%, and our understanding is that we have grown a bit of market share, and that's really pleasing to see. Our cost base is primarily fixed. Our job is to drive operational leverage to improve returns to shareholders. So why buy shares in H&T? Well, we are the market leader. We've been around a long time, and we have a diversified portfolio, but overwhelmingly, we are a pawnbroker and jewellery retailer. We want to deliver strong returns to shareholders. That is underpinned by the growth in the pledge book, with revenue used to drive the jaws to widen out against a predominantly fixed cost base. So 2 years ago, we set a target to achieve sustainable post-tax ROE in the mid-teens. That target was set before the impact of a couple of years of higher cost inflation that was anticipated, and actually before the previous government chose to increase corporation tax from 19 to 25%, because obviously it's a post-tax measure. The target is not changing. The target is still there, and we are determined to get to that target level of returns in the mid-teens. It's a bit harder to achieve now, but we are determined to get there. The majority of our shareholders value and welcome the dividend. Some would rather we didn't pay dividends and did other things with our capital, but the majority of our shareholders value the dividend. We do have a progressive policy. We want to keep moving the dividend upwards. The dividend for the half year that we've just announced is 40% higher than it was 2 years ago, and we think it's important that we continue to move the dividend in the right direction. There is a structural growth opportunity, which I think we've talked about. The target audience is growing, and particularly with small business owners, we think the target audience is potentially very large. And we can improve and broaden the store footprint. We want to be a responsible citizen where we operate, a good neighbour in the communities in which we operate, and we focus a lot on that. And we have very high customer advocacy as a result of it. And we believe that our business model is sustainable. So pledge lending, the collateral is always within our control, and in 99% of cases is represented by precious metal, gold, jewellery, watches. We don't lend against depreciating assets. We don't lend against mobile phones, against PlayStations and things like that. That's not what we do. 99% of what we do is gold, jewellery and watches, which involve an inherent store of value. There's no recourse to the borrower at any time, which makes pawnbroking very different from other sorts of lending. And we have a strong control and underwriting culture and strong advocacy and high levels of returning customers. So we think there's a strong reason to invest in H&T. So just to finish, I think we've made really good progress in the first half of this year. We had 14% increase in lending, 17% increase in retail sales by volume, 27% by value, 9% growth in transactions in foreign currency, 10% revenue growth, and we're working hard to keep cost inflation down to a level which is less than wage inflation. The one thing that went against us in the first part of this year was, as we've discussed, the higher level of redemptions. And it's customers that would have paid their loan off anyway, paying it off a lot earlier than they would otherwise have done. Now, this dynamic emerged for the first time in 2023. The difference in 2024, as Di explained earlier, was there was a lot more of it and it went on for longer. It has now normalised and the pledge book is growing again. Our planning assumption is now that this appears to be a new normal, and our plans and our forecast, although we will do everything we can to offset it, assume that that is the case and that the growth in the pawnbroking book is not linear through the year. Now, one of the upshots of that is it means that all three of our primary revenue generating product sets, pawnbroking, if it is the case that it continues, retail and FX, those revenues are skewed towards the second half of the calendar year. That is the reason, after consultation with a number of our shareholders, that we decided to change the year end. What it will do, it won't fully, but it will to a degree balance up the revenue streams across what will be the two halves of the new financial year. So we will be doing this from 2025, when we will publish results for 2024 based on December as usual. And when we do publish to the new dates, comparatives will be provided. And as I say, our target to meet mid-teens post-tax ROE in this business has not changed, and we will get there, I am certain. So thank you very much for listening. Really appreciate it. And now Di and I are very happy to take any questions that anybody may have.
And we have a few questions. The first is, am I right in thinking that growth is slowing?
Loan demand isn't slowing. It's up 14%. I think what we now have is a business. Historically, pawnbroking had little or no seasonality. There was a little bit, but not much. And certainly not much seasonality in the redemption profile or the timing of people paying their loan off. The pawnbroking business is 2.5 times the size that it was at the end of COVID. And the fundamentals haven't changed much. So average loan sizes haven't really changed very much. The median loan is still £200, which means half our loans are for £200 or less. So what we're doing is serving a lot more people than we've done historically, some of which are new to H&T, some of which are new to pawnbroking. And it would appear that there is now a seasonality in the way they manage the product. If you take a longer term view, it's good because this is people using the product as it's designed. But it means that we now are assuming that that seasonality will result in the performance of the pledge book not being linear through the year. It is growing again now, not because lending has grown more, although it's up. It's because redemptions have normalized. So the book currently is about 108 million. So it started to grow again at the back end of July. And I'm really pleased to see that. So the answer is no, but I do think that we now have a pawnbroking business that has a degree of seasonality within it that was not the case historically.
Do you really need to change your year end? It often suggests a company is struggling.
So the reason we're changing the year end, and hopefully I've explained that one, is because we appear now to have all three of our primary revenue streams skewed to the second half of the calendar year. And to try and even those revenue streams up between the two halves of the year, we firmly believe is the right thing to do. And I don't think we're struggling.
And how's cash generation going?
Sure. So cash generation, I can actually go back to the slides. We've generated, if we look at our free cash flow for the most part of this year, I think £6 million of free cash flow. Our cash is really being distributed to grow our working capital. We are very happy as well that we have our increased funding facilities. We've increased that to £85 million at the beginning of this year. Our total borrowings at the end of June was £64 million. That's our gross borrowings. So actually we have headroom of another about £20 million. So for us, we are comfortable with those levels of debt that we have, with our net levels of debt and the gearings that we have on our balance sheet, and the facilities that we have in place. We actually have a lot more detail in the presentation right at the back around the various components and the breakdown from all of our three lenders.
So if I can just add something to that, Diane. The most profitable place that we can deploy our capital and our cash is in growing the pledge book. alongside that, we're investing in growing and refreshing the store estate, and hopefully the chart we put up earlier showed that the growth's coming from across the estate. But in terms of capital deployment or cash deployment, the best place we can put it is in growing the pledge book. And our planning assumptions are that the pledge book will continue to grow, albeit perhaps in a less linear way than was the case in the past. Now, in the event that that doesn't happen, or that the pledge book grows less, then we will reconsider capital allocation. But right now, driving the growth in our working capital is the primary route by which we grow earnings over time.
And you state a target of mid-teens return on capital or return on equity. By when is this expected?
So we said across the cycle, and we will get there as soon as we possibly can. So that when we set the target, that was before the level of cost inflation that the business had to absorb, primarily relating to wages, both within the business and in suppliers, and before the tax rate was put up. So it's more difficult to deliver than it perhaps was when we set it. Target's not going to change. I'm not going to put a date on it because the company doesn't provide forward guidance and forward forecasts. But we're at 12% now, and we will get to mid-teens.
And does the board fear the change in redemption rates could be caused by the recent increase in the rate of interest applied to loans?
That's a really good question, and the answer is no. So the redemptions were across the whole book, all vintages, all loan sizes, and all geographies. And we've also got 14% growth in lending demand. We have been speaking to all the customers that redeem their loans to understand the background to it, why they did it, etc. And our expectation is that, well, they're already beginning to come back, actually, and that it's a seasonal phenomenon rather than a systemic one. But the increase in interest rates does not appear to be one of the drivers. It's a whole range of other factors, ranging from people feeling a bit better off, given that the average loan is £200. Some of our customers like to take their jewellery out to wear it at religious festivals and spring weddings and things like that. There's a whole range of reasons for it. But what we are pretty convinced of is that it is a seasonal factor rather than a systemic one. And I'm not aware of instances where it's linked to the recent increase in interest rates.
And if I could maybe add a bit more colours, I think that it's broader than something that's just impacting H&T. There's been other references to it by some credit card providers and mortgage lenders. So it is, as Chris said, not really related to the interest rate, probably more related to customers and where customers find themselves, especially in early spring.
So as Di says, actually earlier this year, a couple of the big credit card businesses said that they saw credit card balances reduce in the spring, but that's now reversed. And there have been some of the specialist mortgage banks who've said they've seen more people in the spring paying lump sums off their mortgages. So it's not unique to us. It's material for us because of the nature of our business and the fact that the yield on the pledge book is so high. But I don't think it's systemic for us, and I certainly don't think it's linked to the interest rate.
And regarding Maxcroft, what are some of the benefits that you've learned from them that you're now able to implement across the business?
So there's no rocket science in it. It's really understanding what they did, take it differently, that we can learn from. So in the case of FX, one of the things we've learned is the positioning of rate boards. So if the rate board looks slightly different and is positioned slightly differently, it would appear that it is seen by people who perhaps aren't looking for it. So if somebody's in a high footfall area walking along, if you position that rate board differently and it looks different, they're more likely to actually see it and think, oh, actually, maybe I'll go in there to get my currency because it's a good rate. Whereas before, perhaps we hadn't positioned them as well as Maxcroft did. Now, it's not something we'd really thought about before, but when we looked at what they were doing differently, one of the things they were doing differently was how they position the rate boards. We tested a few. We've now got about 25 stores where we've repositioned it and changed the way it looks. And in all of those stores, we've seen an increase in footfall and an increase in transaction volume. So it's not rocket science, but it's actually really understanding what is done somewhere that's different. As regards lending to business customers, what we've learned from them is how you change the way you position your business within the business community which surrounds the store, in order that people are aware that we're there and seek to use us perhaps for a service if they need to. And one of the ways of doing that actually is to promote foreign currency to some of these businesses. So we've learnt how they positioned themselves to attract a slightly different demographic from what we would traditionally focus on. And I have got stores where the pledge book is growing at a pretty fair rate, but that a lot of that growth is coming from business customers, and it's partly because the store manager, the store staff, have gone out and positioned themselves differently and become better known perhaps with some of the business owners that sit around the store, and promoting all of our products, not just pawnbroking. That was a long-winded answer, for which I apologise, but there's no rocket science in it. It's just really understanding what they did to build such a successful business and looking at ways that we can perhaps apply that elsewhere.
And are you expecting a significant resumption in the pledge book in half two and beyond?
As I've said earlier, we think that this is a seasonal factor. The pledge book is now growing. It's only a few weeks since it normalised and started to grow again, but there's no sign of redemptions going back up. It does look like this is a spring phenomenon. The book has grown 3 million in the last few weeks, and our expectation, our forecast is that the pledge book will grow for the remainder of the year. We are, however, assuming in our plans and in the forecasts that the seasonality repeats in future years. It's happened twice. I think we got the start of a trend. It may not happen next year, but we are planning and assuming that it does, and our job will be to try and offset it, because there's two factors to it, as Di explained earlier. There's the size of the pledge book, but there's also the impact of this redemptions on yield. So we will be looking to try and offset it if we possibly can. But our assumption is, yes, the pledge book will grow for the remainder of this year, but that seasonality will repeat next year.
And last year, retail trading in the pre-Christmas period was below forecasts. What are you doing to try and prevent that happening this year?
So we said when we spoke to some of you earlier in the year that we were looking at the mix of our stock, the ranges that we had. We worked really hard on that, and I'm really pleased with the progress in retail. So we've sold 17% more items. We've seen strong demand for new, strong demand for watches, and growth in pre-owned as well. So I think that we are probably set up as well as we possibly can be for the Christmas period, given that it's coming off the back of significant growth year to date. So our aim is to keep that going and make sure that we are as positioned as well as we possibly can be for that pre-Christmas peak. But we said we would focus on the ranges and how we merchandise them at the start of the year, and I'm really pleased with the progress that we've made in that regard.
And if I could maybe add another point to that is, a quarter of what we achieve in retail sales is driven by our online sales. And we have spent a lot of time, as we've mentioned, referencing our investments in our IT and our technology footprint. So we'll continue to invest in that. And that, for us, the reason why we want to drive that online offering is because that, again, supports our retail growth. Of those transactions which originate online, so those online transactions, which is a quarter of our total sales, half of those online transactions get finalized and completed in the store. So again, the importance is that it does also drive footfall to our stores.
And do interest rates get higher as the loan gets older?
No. So a pawnbroking contract is fixed term, 6 months. You can pay it off any time you want. It's a daily interest product, but the answer is no. The difference in interest rates is linked primarily to the size of the loan.
And with the exception of you, Chris, the director shareholding remains low. Do you worry that that may be a concern for potential new investors?
So this is a question that does come up fairly regularly, actually. So I own just under 200,000 shares, the overwhelming majority of which I purchased either in the market or by subscribing to the share raise that we did a couple of years ago. Not everybody is in a position to do that. The board is aware that the shareholdings of the directors could and probably should be larger, and it's something that they will look to address over the time. I'm speaking to the chairman later, and I will mention to whom that this issue has been raised again. But as I say, not everybody's in a position to buy substantial chunks of shares in the market. How the board addresses that over time, I will raise with the chairman when I speak to him later. But they are aware of it, and it is something that does get raised from time to time.
The interim dividend has increased by less than 8%, and your latest update says this reflects the confidence in the business. Does a less than 8% growth demonstrate real confidence?
So we believe it does. We have a policy that says we will move the dividend up as profits grow. The dividend that we've announced is actually 40% higher than it was 2 years ago, because there was a much bigger increase in the first half dividend last year. We do have to be mindful of capital allocation, but it is a substantial increase over a 2-year period, and our intention is to continue to move dividends upwards and forwards as the business progresses. So yes, we are confident in the future of the business, but we do have to be mindful of capital allocation and try and get the balance right.
And that's the end of questions. Do you have any closing remarks, Chris?
I just want to say thank you. Thank you for the support that we get from shareholders, and it's heartening that that people are prepared to give their time up to listen to the H&T story. So thank you very much to everybody for joining. Hopefully it's been informative, and look forward to speaking to you again when we next report. Thank you very much.